All right, good afternoon, everybody, and thank you for joining us today for a webinar with Fiera Capital presented by SSQ Insurance. My name is Stephen Paul, and I work at SSQ as a business development rep. We are pleased to welcome today Nicolas Bourgeois, Portfolio Manager, Global Asset Allocation, and Jean-Guy Muret, Vice President and Portfolio Manager, Fixed Income, here to talk to us today about global economic outlook and asset allocation. Please note that if there is enough time at the end, it will be our pleasure to answer one or two questions that you can ask via the WebEx platform. You can just submit those in the Q&A section. You can also communicate with your SSQ insurance representatives for all other questions, and I will provide all of our contact information by region at the end of this presentation. Just a quick note, all of you are muted and you can ask questions in the Q&A as I mentioned or in the chat box, and you must attend the entire presentation in order to obtain your CE credits. CE credits will be sent out in about 2 weeks after the presentation. Without further ado, I'm going to pass it off to Jan to further introduce Jean-Guy and Nicolas, and the floor is yours.
Thank you very much, Stephen. It's a pleasure to be with you today. We all hope that everybody's safe and doing well. As at Fiera Capital, it's been 7 weeks that we've been working from home across Canada with many trading desks in different parts of the country. Again, our first and foremost element is to be safe in terms for all of our employees, portfolio managers, and ultimately for our partners, which is SSQ. Again, I will let obviously Nick Bourgeois talk about the global asset mix, what we see in terms of the economy, and Jean-Guy Muret, one of our portfolio managers on the fixed income side, will also come in and talk about his playground, which is the Canadian fixed income. So without further ado, on page 4, you have a brief summary of Fiera Capital. I will not take any time on this page. I think the most important thing is to hear our PMs. So I will let Nick Bourgeois take it over on page 5.
Thank you very much, Jan, and thanks everybody here on the call for joining us today. I hope all of you are in good condition, healthy, and with your family as well. So, the plan of the presentation, I will discuss and give you our global economic outlook, what we think will happen, and we'll discuss at the end the scenario in terms of what shape of recovery we should expect based on what we know right now and what we expect in the future. So, let's start now. So, what has been on everybody's mind in the last, let's say, since January has been COVID-19, so the coronavirus that exploded in China and turned out to be a big pandemic, where more than 3 million cases across the globe and more than 200,000 deaths. So we take a step back and we look at how we were seeing things back then in January. We thought that if the COVID-19 would have remained in China and contained, and when we're looking at the numbers of cases and deaths, it wasn't that much for the amount of population within China. The worst case scenario would have been like an expansion in Europe or North America, where we would have had to close and shut down economies like they did in Wuhan. So clearly China stopped counting at 80,000 cases, and the worst case happened and exploded in Italy, Spain, UK, France, and then came to North America. So clearly that has been like a big issue. And the response of the government has been drastic measures, shutting down economies, keeping only essential services open, such as the health care system, agriculture, technology, finance, and energy, which is not really doing really good right now. And we had some other other measure up in different countries, such as Sweden, South Korea, and Japan, where they opt not to close all the economy, but only apply social distancing. So if we realize in times that COVID-19 might be a seasonal disease or virus like influenza is, maybe the plan of Sweden and Japan and South Korea might be adopted instead of shutting down economies like we are having right now. So, of course, shutting down the economies has major consequences for the economic system, especially in a levered economy. So if we would have zero debt or zero debt on balance sheets, that will not be that much of an issue. But when you shut down economies and you force a company to stop selling goods, well, it's a bit hard for them to pay their debt and interest, even though you had some measure to postpone and do some payment deferral. So this is where the big issue lies. And by shutting down economies, we've seen like a surge in unemployment claims in the US, where it passed like 22 million claims in less than 3 weeks. It doesn't take like 10 days in Canada to reach more than 1 million. We expect earning on of corporation in US and Canada to be down for the next year, actually. And we saw the S&P going from 33,400 level to 2,200 and bounce back to 2,800s. As we speak right now. So why is that? Well, if we move to the next slide, the reason is because of major support of central banks across the globe. So on page 6, you can clearly see that the Fed, Federal Reserve, and Bank of Canada has cut aggressively their interest rates, and those were the only one that had the flexibility to cut rates, because in Europe and Japan, rates were already at 0 or negative. So you had more than 100 basis point cuts in Canada and the US to support the economy. The thing is, we think that we don't think the Fed or Bank of Canada will go negative. We've seen it in Europe in the last 8 years. Negative interest rate hasn't done that much good, or being able to bring back inflation or support more growth. Actually created more like issues and inequality, I would say, and price discrepancies, especially in the real estate sectors. And bring negative rates in the US or Canada will be really negative for the financial sectors. The weight of the financial sectors in the US and Canada is really big, and we will be surprised to see Bank of Canada or the Fed to go negative. It's possible, but we don't expect it to happen. So, like I mentioned, even though you cut rates, it doesn't really matter if your company is not able to pay their debt. So even though rates are low, if you can't pay debt or can't find financing because there's no liquidity in the market, it doesn't help really. So the Fed, Bank of Canada, and central bank across the globe had to step up as well. And this is where they move again and relaunch QEs. So on page 7, you can see what the major central banks across the globe did. So we've seen major and massive amount of bond purchasing. So, but this time, not only like in 2008, where they were buying only government bonds, now they are buying corporate and high yield. So they are buying high yield as long as it was all the bonds that were downgraded since March 22nd and have a maturity of less than 5 years. So the goal here is really to support the fallen angels, such as Ford and other names that I won't go down the list, but really here is to control the curve, the corporate curve spread, and so it doesn't blow out, and keep some normal level and provide some liquidity in the market. In Canada, it's the first time that the central bank is buying provincial bonds across the globe, so that's a big program of 50 million, and they will also be buying 10 million of corporate bond as well in the coming months. In Europe, they give some flexibility in terms of collateral, and they remove some cap in terms of weight of what countries they can buy. So here again, central bank really apply big stimulus in the system, and with the goal to help clearly liquidity and contain and keep spread at the level that is the more normal level. But at the same time, this is not like financial recession we're having. The economy has stopped, so this is like a real economy. So really what we need and for support is fiscal stimulus. So we've seen across the globe like a good coordination of major governments where they've been doing major fiscal deficit and injecting money in the system. So this is what we see on page 8 actually. So in the US, they did like a stimulus of more than $2 trillion. They expand jobless benefit, more than $500 billion in funds to help like specific sectors. Big loans program to help like the small and medium enterprise. Canada, a bit the same thing at the smaller level though, but same level in terms of GDP. So big direct support for consumer and businesses. And we are aware of the measure right now, like the $2,000 going to workers that have been affected or been laid off because of the COVID. So that will help and buy sometimes. In Europe, it's mostly Germany. Germany has been blamed in the past for not doing some fiscal stimulus, and they always had the same answers. We're going to do fiscal deficit when we'll have a crisis and it will be needed. And they always prefer to manage their budget in the more conservative ways. And they are basically the only one in Europe with the fiscal flexibility to do some deficit without having like a huge impact like the other countries such as Spain and Italy on their budget for the future. So they went big, and they're being like doing big fiscal deficit with direct tax measure to support the economy. They will also take some direct grants in small businesses, and also launching like major loans program at low rates to support the local economies. Now, looking forward, what does that mean? That big amount of stimulus from the government and more intervention? Well, we think it might have a big impact on globalization. So we will not be surprised to see government asking manufacturing to come back in developed countries to support and create more jobs in the future. So maybe a bit more protectionism. So we started seeing it in the US in 2016, a bit earlier, but now we think it might be like across all developed economies. So that might be negative for EM countries such as China, where we've seen like even like we saw some orders of masks being like not meeting like the criteria to be used in the hospital. So maybe people will be willing to pay a bit more for quality and making sure the thing is being produced in our own countries. And in terms of regulation, maybe some regulation in terms of stock buyback of what the company can do. Actually, we've seen like a bailout of airline companies of more than 50 billion. And actually, airline company have been using almost 50 billion in the last 10 years to do some stock buyback. So that was like more short-term mentalities managing without keeping a buffer in case of a crisis. So now they've been buying stock for the last 10 years with all their free cash flow. Now the government is stepping in and giving them a bailout of the same amount of what they've been buying their stock. So maybe we will see later more regulation on that front, and that will depend also who wins the next election in the US. In those special time as well, we've seen the oil price collapse last week. If you were in front of your screen, it was a bit crazy seeing the spot price collapsing to minus 37. So yes, people were paying to dump their oil because there's a lack of storage capacity, and that has a big negative impact also on that sector. So there's shutting down economies, create like a lack of demand, and there's also it's already an oversupply. So low price of oil is not only because of COVID, but because also the Saudis started before by undercutting prices to the Russian when they decided not to agree to keep like the supply at a lower level. So the Saudis decided to punish the Russian by undercutting prices. So prices came down lower, and now the COVID hit, and we are now like at really low level, especially in the short end of the curve. But when we look like 12 months down the road, our price is close to $30 on the future curves. So the way it will move, it will all depends on how fast we go back to work and how the recovery will be. So now in terms of asset allocation, so what does it mean if we look at our key research pillar? First one, economic fundamentals. Clearly, we think that we will have severe economic and earning fallout in 2020. Potential for late year recovery, depending how fast we get back to work and the containment is successful in against the COVID. Central bank and government are really bringing good support, and they've been really fast and way faster than 08. So the support they're bringing to the market is clearly like buying time and helping the market run better. In terms of valuation now, we think the market is a bit overvalued, especially the S&P right now trading at 21 times forward-looking earnings. So we think it's a bit high considering the amount of uncertainties in the market, and especially that a lot of companies are dropping all their forward guidance and they don't want to give any insight in terms of what they can expect because they don't even know. And something that we need to keep in mind is at the end of December 2019, there was like more than 5 trillion of goodwill on US corporation balance sheets. So that's a lot, especially when the GDP is like close to 30 trillion. So pretty sure some company will be forced or had some pressure to write off some goodwill in the coming months because it's going to be hard to justify that amount of goodwill on the balance sheet when your earnings are collapsing and everything is going down. Now, in terms of volatility, we expect more volatility until the COVID has been successfully contained. So we need to get used to a bit more volatility and not like the nice 25 to 50 basis point up move that we saw in 17 and 18. So we expect a bit more volatility on that front. In terms of economic scenario, we always work with 4 scenarios. On page 12, you have the 4 we have. So our main scenario with a probability of 50% is a subdued recovery. So this is a mildly optimistic scenario where actually like a medical solution, an existing medical solution is proving effective and is dampening the pandemic, and where the social distancing also help contain the contagion of the virus. So, which brings like certain degrees of confidence to investors, also consumer, and gradually when we are reopening the economy, people get back to work and a bit more to normal. But there's been a big psychological shock to both consumer and businesses as well, and that shall drag also for a couple of months, see years, depending how fast we get a vaccine against that virus. So in that scenario, people get back to work gradually in Q2, and it's gradually coming back Q3. So it's like more at the end of the year, we might see some growth, but we don't expect like good number coming from companies in Q2 either. The second scenario is a prolonged slowdown. This is more like a stop and go scenario where the markets remain confident that a vaccine will be found available sometime in 2021, but quarantine and lockdown in different regions will still be on. So that will create some steep contraction even further and no growth until late 21. So that clearly affect consumer and businesses, and that will be a negative scenario and more a longer recession in that front. So something I forgot to mention, we hear a lot about like a shape recovery. Will it be like a V shape, U shape? So our main scenario, it will be more like a U shape, gradual U shape, but we still keep in our scenario like a 15 probability where we see a rapid recovery with a V shape. And in that scenario, this is where like therapeutic is discovered in the near term and really prove to be sufficient. So if that's the case, people won't be scared to go outside, and company will start working again and selling goods. So with all the stimulus we have in the system right now, with all the central bank and the government support, we should see like a strong growth in 2021 and the second half of 2020. So that's really optimistic, but we only put 15% probability on it. And the last scenario is like a major recession. So this is where there's a failure to contain the global pandemic and it just get worse. Quarantine continue, work stoppage as well, and we see a lot of bankruptcies. And this is the ugly scenario. But we put 10% as we think that the most probable scenario is that we go back to work gradually in a smart way, and the virus will be contained eventually with either a vaccine or a medication. So on slide 13, before I pass it on to Jean-Guy, you can see our GDP growth forecast per year and per recovery. I'm not going to go through all the numbers, but you can clearly see that even in our main scenario, we expect like negative growth of GDP in 2020 and starting to recover gradually in 2021. Inflation, that won't be an issue, especially on the headline inflation this year because of oil being down that much. But if we look at core CPI even last month in Canada, if we extract energy, it was up 0.1. So food is up, and depending on how fast we go back to work or go back to normal, core CPI should not be heading too much south and remain positive or flat. And especially if we see more manufacturing coming back to developed economies, a bit more long term. I will not be surprised to see inflation back to 2 and above. So I will not be surprised on that front. We expect rates to remain low for a while, as central banks are there to support and in those hard times of recession and COVID. And to finish on that front, we expect short term, we might expect like a pullback on the S&P. As I mentioned, we think it's a bit overvalued. And we will not be surprised to see it test the low again of March, or maybe a bit higher, and then to trade at more attractive levels before going back for a nice leg rally. But for now, because of the amount of uncertainties, we don't think it's an appropriate time to add to the existing position or being more overweight. So right now, we're more neutral equities as a whole and waiting for a better entry point than it is right now. So this is for me, and I will pass it to Jean-Guy for his presentation.
Jean-Guy, maybe make sure to unmute your microphone. Thank you.
All right, sorry. I thought I've hit the unmute. I'm Jean-Guy Meret, and thank you for having me on this conference call. And hopefully I'll be able to share with you some highlights and also some light and news and the way we're focusing at what to look for in the Canadian bond market. And without further waiting, let's flip to page 15. And please keep in mind, all through my presentation, I will try to identify the two basic risks in the bond market. First is volatility, and the second is uncertainties. And I will try to show you how these two are priced in the Canadian bond market. So with some of the highlights, like Nicolas said, we're really facing a recession, and it's going to be really different from 2008. Actually, the last recession we had was somewhere around 2000, 2001. 2008 was a financial crisis, and not everybody was included in it. It was mostly some countries and specific sectors in the marketplace. But this time around, everybody globally is involved and hit by that. So this is really different. Something else that is different also is that corporate balance sheet are weaker today compared to 2008. Since 10 years ago, we've seen rates going lower and lower and dividend yield going higher and higher. So it was an easy trade for corporate CFOs to buy back their stocks and issuing debt because they were able to borrow at such a low rate and get a higher return buying their stock. But this had the effect of rising up the debt to equity ratio. And this is not good news for bondholder because you get a weaker guarantee owning the bond of that specific name. Something different also is that the brokers are taking far few positions from us when we're trading. 3 or 4 years ago, there was some regulation change in Canada which affect the way the banks and dealers are financing their inventory. It costs more now for them to finance inventory. So they're less incentive. They have less incentive to trade with us and to buy back our position and to keep them in their books. In 2008, when spreads were wide, yields were low, banks were active in the marketplace providing liquidity. But this time around, if we try to pick up the phone and try to sell 50 million, the answer we get, we'll try to find a buyer for you. There's no bid. So this is really different, and that's why you need some finesse to be able to steer through this lower liquidity environment. On the positive side, like Nicolas mentioned, is unprecedented government assist and also bond purchasing program, which the Bank of Canada was doing for the first time. So it's quite huge, and this provide some type of relief as far as the fear of where things are heading to. So that was a positive sign for bondholders. And in that sequence, we did purchase some provincial bonds and the widest of spreads. And also, we increased our corporate bond holdings. We were able to sell provincials and get into underweight corporate bonds in February of this year and also early March. So we've been unhit with the big spread widening that occurred in March and April, since we were underweight corporate bonds, and we had ammunition to be able to seize the opportunity with higher yields, and that's what we're going to show and then to cover the next couple of pages. So if we turn to page 16, sorry, we just showed a 10-year Canada bond yield with some history, and we're seeing that we've hit a low of 0.55 in early March, and it's stabilizing at 0.60 right now. But we see that last year, actually, rates went up from Q3 to Q4 at the end of the year because the big tariff war was coming to a halt with the phase one accord. So rates were backing up to a higher level. But since then, we've hit really a low point in the historic low for Canadian bond market. On next page, on page 17, then this how we can show and see volatility. On page 17, you have the 30-year Canada bond yield that have hit really a low point of 0.71. That was on pure fear and pure emotion. It came up on a Monday morning, and I remember I've lit up my screens and I've saw something I've never heard in 35 years of working in this industry. Bonds were up $20 in a single day. $20, remind that the bonds are trading on a $100 basis. So that's 20% rise in total return in just one day on pure fear. Then we were at the height of the epidemia spreading in Italy and also in the rest of Europe. So the market didn't know really what was the outcome and where they should price rates. And everyone that was short bonds got trapped into that and had to close a position. That's how we can identify uncertainties. Then bonds came back to their senses, and now we're hovering around 1.25% yield on 30-year Canada. But at some point for us, this was a trading opportunity because we sold bonds at the low point of 0.70, 0.80 for two reasons. We sold for having a shorter duration, but we also sold a long maturity bond just because it didn't make sense holding Canada bonds at 0.70 yield. We didn't know how long it would take to come back to normal, but we felt that this was unrealistic. Turning to page 18, this I will just show you three examples at the rate structure at three different dates. At the bottom, you got the maturities. On the left-hand side, you got 3-month bills. And on the right-hand side, you got long bonds, 30 years. Blue line is where rates were at the end of the year, December. So remind that we show that rates went back up. Discount rate was sitting at 1 3/4. So the whole market, the whole curve was sitting at 1 3/4. So the market was indifferent between rising rates and lowering rates since it was neutral. For us, we felt that, again, 30-year wasn't really a great risk-reward relationship. So we've decided to sell 30-year and to concentrate our portfolio between 5 and 10 years, just because we were not compensated for the increase in maturity. So we started to buy the mid part of the curve. Then came January, which is the black line, the end of January. This was not the virus. It was mostly with soft economic data coming from the US. You've got some lower retail sales, some PMI that went softer too. So the market was pricing in maybe 1 or 2 rate cuts from the Bank of Canada. And then came March, and now we're sitting with at the end of April with the red line. But if you notice that the market really, all the rate cuts happened with the left part of the curve. We see that 3-month bills really came down 150 basis points, while 30-year came only down by about 50 basis points. So even though rates went down, the long bonds was already at their low point, and it was already pricing in some rate cuts but it didn't live all the rate cuts. So this is a typical movement of seeing a steepening of the yield curve, as we call it, having the shorter rates moving down further than longer rates. So for us, being centered between 5 and 10 years was a great place to make money because even though in the 10 years rates went down like close to a little bit over 100 basis points, long term went down only 50 basis points. So even though we were shorter duration, we were short the right bond, being the long one. So we made a lot of money by being more centered in the yield curve. That's a way to deploy risk and to take uncertainty out of the marketplace. So we feel that we could see some further steepening, but we think we have reached some plateau and we have started to unwind these trades already. On the next page, on page 19, now we're going to look at credit markets. We both going to look at provincials and also corporates. On the left-hand side, you see the interest rate spread between a provincial and a Canada, long maturity, 30 years. So you see that the yield spread, it's 75 basis points. If, let's say, Canada is at 1%, then province will be at 1.75. That's how to express 75 basis points. So that spread doubled almost, going to 135 in a really couple of weeks and days. So for us, we were scratching our head saying, is this an opportunity or fear? And we found it was an opportunity to buy provincial bonds, and we did. And why is that? If we take a look at more history on provincial spreads, that spread of 125 was topping and and being equal to the last cycle in 2012 and 2016, where it was the last time we saw spread widening. The provincials hit that spot perfectly. So for us, they didn't go further. So it was kind of a sign that probably we've reached the top. And further to that, then we had the announcement from the Bank of Canada that they would participate in a provincial bond purchasing program. So that brought a big relief for market participants, probably betting that now spreads have finished widening. So that's where we see the big improvement from 135 to 105 basis points. So we made money on the way up being slightly underweight, and then we made money going down, having purchased with an overweight position. In corporate bonds, it was a little bit different. On the right-hand side, we like to compare corporate to provincials and not Canada's. Corporate and provincials are both credits, and they both react to the direction of equities. There's a straight correlation between equity market and credit market, specifically corporate bonds. So at some point, when corporates are getting too tight to provincials, for us, it's a signal that they became too expensive. We're not compensated for the risk. So it's kind of a spot the entry point, exit point to hold corporate bonds. This time around at 80 basis points in early 2020, we felt corporates were pretty much, had to done what they had to do. So they were getting in the expensive range, and we sold most of the position, and we got underweight by a margin, I would say probably between around 7% dollar value underweight compared to the benchmarks. So there's about 27% corporate bonds in the benchmarks. We had about 21% in our portfolio. And while we saw interest rates spread widening, we purchased corporate bonds, and then they came down with the announcement from the Bank of Canada. Now, this is for the whole corporate bond market, but facing a recession, the uncertainty will be, will all the industry, all the companies will survive this recession? If I would have shown you the same chart with triple B specifically, the story would be a little bit different. Now we did surpass 2012-16 area, but we didn't hit really 2008. Just as indication, 2008 for the same chart was 275 basis points, so way under. But triple B have hit about 200, and they came down a bit since then, but not as much as the whole market. And why is that? Triple Bs, specifically triple B lows, will be the closest to be downgraded if ever companies will get into difficulties meeting their fixed charges. They have no revenues, fixed charges. So if rating agencies get impatient, they will downgrade. And already we had about 12 companies, 14 companies being downgraded in Canada because of this fact. So for us, even though we purchased corporate bonds, we were really, really selective at what the names we were purchasing, making sure that the financial leverage was contained to be more reassured that they will live through this crisis. So the big uncertainties here was, will the company survive? And because of that, the market will probably ask for a premium and not necessarily go back to the previous levels that we had on corporate bonds. This premium could be probably permanent until the recession ends and we get a better tally of what are the falling angels and what will be the surviving companies. Next page, on page 20, just to illustrate where we made money on the yield curve. This is showing the slope of the yield curve. On just focusing on the right-hand side, this is the yield, the difference between 30 years and 10 years. The thing we were looking on the blue line before, where it was flat around 0 at the beginning of the year. Then we see it shooting up close to 70 basis points difference between 10 years and 30 years. So that was a lot of money that we made. So keep in mind that 10 years went down about 100, and we see that big curve moving about 70. So we did recuperate some of the loss that we had being short duration, but we were short the right bond. That's what this is saying. At that point, we are unwinding because as we see on the chart from a historical point of view, 70, 80 basis points is probably the range where a normal shaped yield curve should look like. So there's no way for us to keep that position, a strategy on portfolio. So we have unwind probably 2/3 of that position already. Now I will finish with the last page, page 21. Again, just to compare with Nicolas' scenario, I just want to share you some way of thought that we had last year. We had two scenarios last summer, where they were equal weight, and we feel there could be a lesser economic slowdown or a full recession. And keep in mind, we were at the height of the trade war. So if Mr. Trump was escalating tariff with China, it would have put the U.S. economy in recession. So there was a big uncertainty, unknown right there. And then in January of this year, we had that phase one accord. So our basic scenario was 60% on an economic growth that would probably surprise the market pricing. But we kept 25% on a technical recession because we felt that like Nicolas said, the equity market was a bit running out of steam. But our goal was, even though we were not sure where the economy was heading to, we construct the portfolio in a way that it would react in a positive way, either of these scenarios happening. So if our main scenario would occur, then rates will go up, so we would benefit from being short duration. The curve would steepen, so we would have brought some added value. But on the other side, if recession would hit us, rates would continue going down, so it would be a negative for the added value on the duration decision. But there would be a big gain on curve because the curve would steepen some more. And actually, that's what happened with the way the portfolio did react. And we had a really great performance in Q1 and further enhanced also in April, just because the risk that was put in the market, in the portfolio, were really deployed in a way that the calculation where the best value, the best real return for a risk was being put in the portfolio. So knowing where to deploy the risk is an asset by itself, and a guarantee of success. So knowing also how to react quickly by selling and buying, being active in the marketplace, brings us a lot of confidence that we can attain and also fulfill the objective of the investors. Well, that's it for me. I'll turn back to Stephen for conclusion and question.
Perfect. Thank you, guys. So just here to stay up to date, you can see a little page here, and we'll jump into some questions from the audience, and we'll start with Nicolas here. One of them that I'll read out first. What do you foresee the impact of COVID-19 on the globalization movement that we have seen in the past 20 years? Your vision on the impact in emerging countries?
So because of the COVID and the situation and the big amount of people losing their job in the recession we're going through, we expect this time we don't see the end of globalization. We just see a slowdown of it and maybe some interest of bringing back manufacturing that is being made outside, let's say of the US or Canada or in developed economies, back to their domestic economies, especially on the essential service good. So clearly that will be a negative for China. China will still export goods, but we see like a slowdown in terms of like going for the cheap labor and maybe more like doing some global economy. So yes, Asia, I'm just seeing a question here also. Will there still be an Asian territory? Yes. But we expect also some political pressure and willingness from government to not to force, but to give some incentive for companies to reshore their manufacturing within their own countries to help and support the local economies. Because we have like 22 million unemployment claims in the US in the last 3 weeks. Not all of them will get back to work, because not all the company and small and medium-sized enterprise will survive this. So you will have a lot of unemployed, and clearly we'll have some incentive probably from the government to bring back manufacturing. So yes, we see a slowdown in globalization, and we see it coming out of China and go back to either the US or Canada or developed Europe.
Okay, maybe just one more question for you, Nicholas. We've seen a lot of monetary fiscal investors for the past 4 or 5 weeks. What will happen if there's a second wave? Do central banks / governments have other tools to support the economy?
That's a good question. So in terms of interest rate cut, they are really limited, because now we think they are at the lower bound, and even they go negative, we don't think that will have any impact on the economy. It's more on the fiscal front. Like, yes, well, the hidden card that the Fed can do is do like Bank of Japan and start buying equities. But I don't think they want to go there. But yes, fiscal, the best scenario, hopefully there's a containment of that virus, because the measures that are in place right now from the government are only buying times, and maybe a quarter, maybe up to 3 to 4 months. But yes, after that, if they want to keep the economy shut down, they will have to reprint money and do even bigger deficits. So that might create some problem eventually on even government balance sheets. So the amounts of tool they have, they will need to be really creative. But the best thing is to get back to work in a smart way and gradual way, so we get back to normal. But yes, I'm in the camp of limited tools that the central bank have at this point.
Perfect. Thank you, Nicholas. And Jean-Guy, we'll just ask you a couple questions. For how long do you imagine that the rates will remain low?
Well, if we're talking about the discount rate from the Bank of Canada, I think we're in for maybe probably close to a year, or maybe less than that. But it's going to be at least 2 quarters, because before that the bank would raise rates, they will have to be sure that we have clear blue sky. So the left part of the curve will probably be anchored with the Bank of Canada, and probably they will drag their feet, even though they're seeing some positive economic numbers. They will probably stay low for a while, because there's no risk to see inflation shooting up. Now, for the long part of the curve, if really the market is having a V-shaped recovery, that means that all the instruments put in place would have been successful. Then we would probably see the yield curve steepening quite a bit, because long-term rates will remember where they came from back in December, which was 1.80% yield, sitting at 1.25 now. So it will be probably the steepness of the yield curve that will predict higher rates for the long-term maturities, but short-term will be anchored for quite a while.
Perfect, thank you. And is it still useful and relevant to keep bonds in an investment portfolio from your perspective?
Oh yeah, that's quite a interesting and good question that we receive a lot now, especially with the level of rates right now. I would say yes, it is, and mostly with an active management type of approach. First, why fixed income are still interesting for portfolio? Well, you got a stable income with bonds compared to equities, and it's we are realizing it right now because we see companies cutting dividends. So the stable or supposedly stable dividend that you can have with a company have been slashed just because companies need to conserve cash flows right now, and they're not shy of going from 100 to 0 as far as the dividend. This won't happen with bonds. Second aspect would be diversification. As with equities, I mean, when equities goes down, all the equity market goes down. Compared to bond markets, not all markets will go into the same direction. And you got some also volatility that will be more extreme with corporates and governments. So an active manager will be better to exploit that and to be able to protect capital. And that brings me to the third argument would be capital protection. Now we got a way to preserve capital with bonds as long as you're not taking too much risks with a corporate bond market. Then this is the role of an active manager, making sure also that you can provide liquidity. And liquidity was a big factor lately, the last couple of weeks, especially with all the structured product or the ETFs. People just realized that the pricing of ETFs was a bit awkward compared to the NAV and to book value. So this is really a particularity of the structured product, which you don't necessarily have in the cash bond market. Obviously, yes, there is sometimes it's tough to trade bonds, but it's going to be for a couple of days, couple of weeks. But after that, we were able to provide our client with all the cash flows that they required. And looking at government bonds, you got the best guarantee as far as security. We haven't seen defaults into government bonds yet and missed a coupon. So for us, it's a great security owning bonds, even in the low rates environment. And like go back 6 months, if you felt like 6 months ago rates were already low, and where you would get out of bonds because you were tired and not getting any money, you would have missed out on some great opportunities owning an asset that made almost double-digit numbers in the market. So I think it's always good to have fixed income investment in a portfolio just for diversification and the guarantee of income.
Okay, perfect. And we'll just ask one more question, and then we'll wrap things up here. Are negative rates a solution envisioned by Bank of Canada?
I think Nicolas has touched upon that subject earlier, and I go along with his opinion also that we feel that here in North America we will not see negative rates. It doesn't say that market could price in negative rates, but we don't think that the central bank would go by their own, calling bank rates being under zero. And why is that? Is we feel that it's going to be just like pushing on a string. Nicolas touched upon that though too, that it's not monetary policy that is the only tool that will be effective, but mostly the fiscal policy. People don't need low rates and they need money to spend for a couple of months to be able to survive. So even though we have low rates, we negative rates, it won't issue or solve the problem. And actually, probably 4 or 5 years ago, I went to a forum seminar with the Bank of Canada that was actually looking at the effect of negative rates. And they told us, yes, it's a good tool. It is a tool that is now innovative, but you shouldn't use that for a long-term period, like 6 months, 9 months, because if you go further along, longer than that, it would probably create bad behavior. And that's what we're seeing in Europe right now. Having negative rates for the last 4 or 5 years have brought really market with some bad reaction. And right, think of this, a company that borrows at a negative rate. This is totally illogic, and it's not really risk sensitive and risk adverse. So for us, at that time, yes, it would probably not be a good idea owning bonds with negative rates because you want to get a positive return out of the bond usually. So we expect central banks here to be more normal, and we have probably seen the low of rates as we see it right now.
Perfect. Thank you, Jean-Guy. I'll just pass it over to Jan if he has any final remarks before I quickly just show the contact list at SSQ if you have any further questions.
Thank you very much, Stephen. It's going to be just 30 seconds. I just want to thank all of you, and I think this is quite a turnout. So we're very happy to have had the opportunity to present. Keep in mind that hopefully this was interesting. The presentation will be shared with the audience, so we all hope that you will be taking away some elements here. One of Jean-Guy's points is obviously active management. We do believe that, as he mentioned, with the downgrades in the Canadian market, there is room for active management, and obviously in terms of the asset mix positioning, hopefully Nicolas' points gave you some thoughts also. Stephen, back to you.
Perfect. Thank you, guys. I'll just put up the contact sheet for Fiera Capital. If you have any inquiries, you can see the contact list there for your respective regions. And then I'll put it over to the SSQ contact page. Again, thank you, Nicolas, Jean-Guy, and Jan for presenting today. And we appreciate your time, and we hope everyone is safe and stays healthy. Thank you.